The hottest inflation in 4 years isn't enough to cool the hottest tech rally in a generation. So slap your forehead if you want, but this is the reality of the stock market and the economy. AI tech investment that's driving more than a third of GDP, and just 10 of the 500 S&P stocks driving 2/3 of the gain since the benchmark index hit that year-to-date low back on March 30th.
Hello and welcome to the week ahead on Nomura Podcasts. I'm your host Andrew Ticehurst from our Global Markets Research team, and today's Friday the 15th of May. I started there with a snippet from Romain Bostick from Bloomberg. I thought he was capturing the current mood across macro and markets quite nicely. This week we've seen some hotter inflation readings in the US, and oil's been back on the rise too, with no signs of progress towards reopening the Strait of Hormuz. That has seen US bond yields push higher, with the 30-year again moving above 5%, and amid some pretty underwhelming US bond auctions too. UK yields pushed higher this week as well, with Prime Minister Keir Starmer's woes continuing. And a quick shout out to my European colleagues who wrote a piece this week titled, "Can Keir Starmer Steer Karma?" I think they've got the title of the week there. But despite continuing oil supply, inflation and geopolitical concerns, market sentiment has been holding up, with the S&P and copper both making fresh record highs, likely assisted by an AI and energy overlay. And market volatility has been low, perhaps surprisingly so. This week, we're going to check in with some of Nomura's global research team. David Seif in New York, Andres Stepaniak in London, Hannah Liu in Hong Kong, Uichiro Nozaki in Tokyo, and my podcast co-host, Yubin Paracueles from Singapore, will also be along. We're going to be discussing some of the key macro data from around the world, central bank outlooks, and some of the geopolitics too. There's much to discuss, so let's dive in.
The ayes are 54, the nays are 45. The nomination is confirmed.
The Fed's new chair, Kevin Warsh, is confirmed by the Senate as the next chair of the Federal Reserve, inheriting no shortage of challenges. Wholesale inflation just posted its biggest annual advance in 3 years. The Strait of Hormuz remains blocked, and President Trump has made it clear he wants rate cuts.
Okay, so let's get going. We'll start with the US, and I'm joined here again by David Seif, Nomura's Chief Economist for Developed Markets. David, welcome.
Great to be here.
Okay, I thought we'd start with inflation. We've had some CPI and PPI readings this week. Have they contained any surprises for you?
Yeah, so they were not hugely surprising, but they do show a pretty hot inflation landscape in the United States. There was a lot to unpack. So first of all, there were the continued effects on headline inflation of the Strait of Hormuz being closed. To a lesser extent, that also impacted core inflation in that there were clearly some travel-related costs that rose, and those do go into core inflation. Beyond that, there was what I would call a technical adjustment that had to occur to housing to make up for a mismeasurement of housing that occurred 6 months ago when the U.S. government was shut down. And that, bottom line, caused there to be on the order of double the amount of housing inflation that there would have normally been in the month. That, at least, has no read-through to the future. The last thing, though, and it didn't actually affect the CPI number all that much, but it portends to what may happen in the future, was that we saw for yet another month extremely high what are called software goods inflation. And really what that boils down to is a shortage of semiconductors, right? And the key thing here is that you really can't write that off as, oh, that's tariff related, or, oh, that's Strait of Hormuz related. That looks like just sort of traditional overheating of the economy, so to speak, that prices are up because demand is up and supply just can't keep up. And so when we look to the future, not just the next month's reading, but several readings into the coming months, it really does give an indication that some of this harder to write off inflation may be coming down the pike.
Okay, got it. I wanted to talk about the Fed as well, and I guess this is a pretty easy segue. Inflation matters a lot for the Fed. We've got Fed minutes coming out next week, and we've also got a new Fed chair incoming. He's been confirmed by the Senate this week. So how's that shaping your outlook?
Yeah, well, we would expect so. We would expect the Fed minutes to show a continuation of the hawkish shift from some members that we clearly saw with the three hawkish dissents at the April meeting. It will likely indicate that more participants favored dropping the easing bias that's implicit in the Fed's statement. Of course, Hammack, Logan, and Kashkari all dissented in that regard, so it's almost certain that the minutes will reflect that. We've also had two other regional Fed presidents, non-voters, Collins and Musalem, indicate in speeches that they also would have preferred to change the language, and so that's at least five. The Fed won't give an exact number, but in typical sort of opaque Fed speak, it will indicate with the choice of words some approximation of the number. And it should be, at least on the order of five, possibly even a little bit higher. Of course, that hawkish shift contrasts with what is likely to be a dovish change in the Fed leadership when Warsh takes office, something that we expect to occur sometime next week. And I think that it's going to be a really interesting thing because Warsh has not said really a word since President Trump nominated him at the end of January this year. And there's a lot of uncertainty. It's our view that he is likely to come in wanting to be very dovish, despite the fact that the data don't really seem to support that. But maybe he'll be less dovish than that. Maybe he'll be more patient than we expect. And then again, maybe he'll be even more dovish than we expect. So that's an entirely separate thing. We'll have to wait until he starts to speak. But it shouldn't be too long before that occurs, even if it's not this very next week. We should start to get an idea about where he at least wants to push the Fed to go fairly soon, now that he is imminently going to become chair.
Okay, got it. All very interesting. David, thanks so much.
My pleasure.
Now, turning to Europe, Andrei Stepaniak from Nomura's London-based research team is here. Hey, Andrei, thanks for joining.
Hey, Andrew, always a pleasure to be here.
Excellent. Hey, we're talking about geopolitics as well as macro this week. And over in the UK, PM Starmer's been attracting all sorts of headlines. He says he wants to stay in the role. Markets are jumping around. UK yields are pushed higher. Do you have a view on all this?
I mean, look, so obviously the key thing is we had the local elections recently and Keir Starmer, so the Labour Party faced essentially disastrous defeat. And so from that perspective, many MPs have called on him to resign or set out a timetable for him to step down. At the time we're recording, we haven't actually had any official challenger to him yet. It's worth noting you need 20% of the parliamentary party to back a candidate to officially challenge Starmer in a leadership challenge or at least election. And for what it's worth, Starmer has said he would fight anyone who did challenge him. That said, there is the wide expectation that Wes Streeting, the current health secretary, is going to resign and will challenge him formally, and that may even have happened by the time this goes to air. There are a few other candidates people are talking about as potential challengers. So one being Angela Rayner, another being Ed Miliband, another being Andy Burnham. The challenge for Andy Burnham in particular being the fact that actually he's not yet an MP, and so depending on the timeline for this whole leadership situation, he may not even be eligible to stand against Starmer by the time we get there. And so there's a lot of moving parts, I would say, and a lot depends on that sort of time frame. We did a Nomura poll actually recently. And essentially, the poll question was, who will be UK Prime Minister by the end of the year? Only 24% of respondents thought Starmer would actually stay as PM, and 35% thought Burnham would be able to stand as an MP and actually enter some sort of leadership challenge. So obviously it's all to play for. Generally speaking, then when you sort of think about from a market's perspective, we've seen how yields have already risen. We already have that political risk premium back in gilt yields like we had back in September 2022. So that's one concern. And from a market perspective, we definitely feel someone like Burnham or Miliband would be, or Rayner even, would be far worse from a market's perspective, and it results in an adverse market reaction relative to, say, Starmer staying on or Streeting beating him.
Okay, it's such an interesting situation there. 24%, that's not great odds for him. Hey, back on the data front, there's a number of economic releases across Europe and UK next week. Let me give you free rein here. What are you going to be watching?
I mean, look, we have to obviously mention the fact that in the UK, you do have two tier one data releases. You've got the labour market reports and obviously jobs there, that's weakening. The unemployment rate was lower before than we previously thought. And also employment growth is slowing. But the key focus from the Bank of England perspective will be on wage growth, clearly. And we also have the inflation report as well, so the inflation data. And we are expecting the next Ofgem change in July. And Cornwall thinks it'll be up more than 12%, whereas the previous cap falling due to past energy moves takes about 0.3 to 0.4 off the headline itself. That's sort of recapping the tier one data. That said, given the Iran war and going on, I think central banks will be more focused on the forward-looking indicators in, say, the surveys. We have the PMIs, we have the INSEE survey, we have the IFO survey, we have the CBI surveys, and these are all surveys where you get forward-looking components on employment expectations and selling price expectations over the next 3 months. What central banks are going to be watching out for is, do those 3 month ahead selling price expectations rise further, given the material rises we saw in the March and April figures?
Okay, got it. And Andre, final question for you. We are pretty tragic central bank watchers here at Nomura. We've had a lot of ECB speak, I think, this week, and some more coming next week. Have you got any thoughts there?
I mean, it definitely feels like with so many ECB members, they all have to say something. Look, I think the one thing to caveat is that some of the ECB speak has been dovish. Villeroy, for example, has said he still doesn't yet think there's rationale for the ECB to raise rates in June. That said, he actually leaves his post on the 1st of June and is replaced by Moulin. So he won't actually be in the mix anymore. In terms of the other ECB speak we've had from Nagel, from Schnabel, Doleng, most do suggest a rate hike in June is coming. And for what it's worth, we had some pretty hawkish comments from Lane overnight. In particular, the interesting thing with Lane's speech was this. The bulk of the speech was quite dovish. He spoke about the fact that central banks have to be cautious regarding the near-term inflation risks and the medium-term growth risks due to essentially demand destruction from elevated energy prices, which makes sense. And obviously, Lane is usually quite dovish. And a lot of his speech focused on the adverse growth impact from higher oil prices and higher gas prices. That said, his conclusion was very hawkish. He basically gave 4 reasons why the ECB could potentially still raise rates in June despite that dovish backdrop.
Okay, got it. Hey, Andre, I think we've covered all bases, so let's leave it there. Hope you have a great week ahead.
Thanks, Andrew. Likewise. Talk soon.
Now, moving to China, let's get the latest from Hannah Lu from our China research team in Hong Kong. Hannah, thanks for joining. Look, as we record this, and it's Thursday afternoon Asia time, we're keeping an eye out for headlines with respect to the Trump-Xi meeting. So let's start there on the geopolitics. Have you got any updates?
Yeah. Funny thing. So like everyone is like looking at this Trump-Xi meeting like it's a show or something. Well, so thus far the meeting seems going pretty well, and the readout, the official readout from both sides will be released on Friday afternoon. Now, if you're listening to this on Friday afternoon or later, you probably already know the official readout. Anyways, from the information we gathered thus far, let's just take a look at the big team of the CEOs that went along with Trump, right? We're likely to see like tons of business deals about China purchasing U.S. goods and making investment towards the U.S. And Reuters also reported that both sides are mulling over to cut the tariff rates on around $30 billion Chinese imports. And this is around 10% of the US imports from China last year. So, yeah, there should be many pragmatic deals around business, around tariffs. But there is a big but. Despite these possible pragmatic deals, which is going to make headlines, we expect the meeting is more about avoiding tensions rather than building and forging a deep friendship. So, in other words, we don't expect any real breakthroughs. For instance, we don't expect the chips which are more advanced than the H200, for example, the Blackwell, to be allowed to flow to China. And also for the Iran and Taiwan issue, they should be brought into the discussion, but it is unlikely to see any formal agreements.
Okay, good one. Yeah, look, just such a critical relationship. We're all watching that one with great interest. Hannah, let's turn to the calendar next week. April activity data will be released. What could this tell us about the health of the Chinese economy?
Yeah, we are likely to see the bifurcation between the external and domestic demand to persist for the April activity data. And we expect both investment and consumption growth to hover just around merely 2% in April. And for industrial production, it is likely to remain quite robust, about 5%, which is boosted by the very robust export growth in April. Though this is down slightly from March because we have less working days in April. Yeah, so the bifurcation between these external and domestic demand is likely to persist throughout the year as we face this Iran war and also with everything going up around this chip prices amid the AI boom.
Okay, got it. Good one. Thank you. And finally, we will also get an announcement with respect to the loan prime rate in China. I don't think we're looking for any movement there. Have you got any thoughts?
Yeah, correct. We don't expect any rate cut. Actually, we have just push out our rate cut forecast for this year. We don't expect any cut for this year anymore. But this doesn't mean Beijing is comfortable or it is complacent about the economy. Beijing still aims to maintain a accommodative monetary policy to cope with the weak domestic demand. But the approach has been tilting towards a more from a price guidance to more of a liquidity injection through open market operations. For example, in the first 2 months, the PBOC has already injected around 2 trillion into the banking system. So the interbank liquidity has been quite flush since the start of the year.
Okay, good one, Hannah. Thanks so much.
Thank you.
Now, hopping over to Japan, let's get the latest from Wichiro Nozaki from our Tokyo-based research team. Nozaki-san, thanks for joining once again.
Thank you. It's great to be here.
Excellent. Look, let's start with the economics. I know that Q1 GDP data will be out in Japan next week. What could that report tell us about the health of the Japanese economy?
On Tuesday, Japan's GDP will be released. We expect annualized quarter-on-quarter growth of 1.0%. A bit weaker than the market consensus of 1.6%. The impact of the war in the Middle East will likely show up only partially in the form of a decline in exports and imports, as well as a drawdown in inventories. But for now, the overall effects on the economy should still be limited. Looking at the details, we believe GDP growth was supported mainly by solid private consumption and rebound in exports. Monthly trade data showed that exports to the U.S. increased strongly, confirming a recovery from the earlier drop caused by tariff policies. In addition, public investment likely rose, boosted by the supplementary budget passed last autumn.
Okay, got it. So, yeah, 1% annualized growth. That's not too bad for Japan relative to potential growth. Look, switching from growth to inflation, April CPI data is coming out too next week. Enormous focus on inflation, of course, globally amid high oil prices. What are you looking for from this report?
We expect core CPI, inflation excluding fresh food, to slow to 1.6% year on year from 1.8% in March. There is still a lag before higher crude oil prices feed through into domestic inflation, while downward pressure from policies related to free education, which were introduced in April, as well as a slowdown in food inflation, are likely to weigh on the inflation rate. When thinking about the underlying inflation, which the BOJ placed great importance on, the trend in service prices is the key. In particular, April, which is the first month of the fiscal year and the peak of moving seasons, tends to see a concentration of price and length revisions. Based on the same month Tokyo CPI data, which was already released, we expect services price to remain broadly flat.
Okay, that will be an interesting one. Looks like a few moving parts in there. That's quite interesting, yeah. Hey, aside from the macro, geopolitics has been a big focus for markets lately. We've got the continuing situation in the Middle East, Trump-Xi meeting in China this week, and there's been some focus on Japan too, with a visit from US Treasury Secretary Scott Bessent amid what is still a pretty elevated dollar-yen exchange rate. What happened in those discussions there?
From May 11th, Bessent visited Japan and met with Prime Minister Takaichi and Finance Minister Katayama. Judging from what they said after the meetings, they exchanged views mainly on FX, the supply chain for rare earth, and responses to AI-related developments such as Mythos. As for FX, the market widely believes that the Japanese government conducted yen buying intervention from late April to early May. After the meeting, Bessent said that excess FX volatility is undesirable and that the fundamentals of the Japanese economy are strong, which can be read as effectively acknowledging Japan's currency intervention. On the other hand, there appears to have been no concrete discussion of fiscal or monetary policies in Japan. It seems that the Bessent is concerned that a rise in the Japanese long-term interest rates could spill over into the US market. But at least this time, I do not think the American side criticized Japan's expansionary fiscal stances or pressured the BOJ to raise rates.
Okay, that's very interesting. Yeah, I think we're all watching those higher long-end bond yields globally. Hey, Nozaki-san, let's leave it there. That's perfect. Thanks so much.
Thank you.
Now, let's move to Asia, and Yuben Paracueles from Nomura's research team in Singapore is here with us. Yuben, welcome.
Hey, Andrew. Good to be here.
Excellent. Thank you. Look, I thought we'd start with Bank Indonesia. There's not too many central banks meeting next week, but they are on the calendar. What are you looking for there?
Yeah, I think that will be a big focus for markets here in Indonesia. We are expecting a 25 basis points hike to 5%. Assigning a 65% probability to that one, but not ruling out a more aggressive 50 basis points, and then the remaining 25 probability to an on-hold decision. So, yeah, I think the main rationale really here is the fact that the IDR has been under some pressure in recent weeks, and with still no clear resolution on the Iran conflict. I think that's one of the key reasons why there's been a lot of balance of payments pressures, outflows, particularly in the equity and bond markets. And, Bank Indonesia has a very strong focus on maintaining FX stability. And they've tried a lot of different measures so far, but it hasn't been fully effective with IDR close or hitting new record lows, I think, this week. So I think they have limited options at this point, except to really raise the policy rate. And, depending on how much rupiah will move from here, they could potentially go aggressive. If not, we still have them hiking again in June, back to back, again, in anticipation of a persistent weakening in the IDR.
Okay, got it. So currency-related rate hike, it does look like a tricky situation for them. Aside from that one, Yuban, the calendar across Asia does look a little bit light next week, but is there anything that you'll be watching?
Yeah, in Southeast Asia, we have a couple of Q1 GDP numbers. And as you know, we're watching very closely, apart from inflation, some of the economic consequences of the war in Iran. So these releases will give us a bit of a hint of the initial effects. So in Singapore, this is the final Q1 GDP estimate. We, in fact, expect it to be revised up to 5.2 from the 4.6 initial estimate. So it's quite a substantial revision. Again, because we think manufacturing output has been stronger than what was penciled in the advanced estimate, thanks to further strengthening in AI-related demand and some spillovers into the overall electronics sector here in Singapore. So that seems to be providing more than an offset from the headwinds in the war in Iran. In contrast, in Thailand, we have the Q1 release as well. We think it's going to be 2.7, only a small improvement from 2.5 in the previous quarter. Again, there are some signs that the initial effects of the war in Iran is already starting to hit the economy, whether it's via tourism. We've seen a very sharp drop of tourist arrivals from the Middle East to Thailand, but also more surprisingly, actually for European visitors, which is a bigger share of total arrivals in Thailand. So yeah, the tourism sector remains pretty sluggish. And we think this is going to get worse in the coming quarters. So, yeah, from a growth perspective, that's actually the bigger worry for authorities in Thailand. So, which is why, in contrast to some central banks in the region, we are very much of the view that the Bank of Thailand will keep the policy rate unchanged throughout this year.
Okay, got it. So, yeah, quite the contrast there across the region. Hey, Yuban, let's leave it there. Thanks so much. Have a great week ahead.
Great. Thanks, Andrew.
And finally, from me, a couple of quick things to look out for in Australia next week. Down here, we will receive RBA meeting minutes from its policy meeting almost 2 weeks ago, the April jobs report and May PMI readings. That RBA meeting delivered a third consecutive 25 basis point rate hike, but communication, which suggested the RBA now had space to consider the impact of those hikes on both growth and inflation. So we'll be looking to those minutes for further clues, with our base case being for no further RBA rate hikes this year. On the labour market report, we look for job gains of around 20,000, which should keep the unemployment rate fairly steady, around 4.3%. And we'll be watching those PMIs too, noting that this week's April NAB business survey revealed both a weaker growth backdrop and much stronger inflation pressures, which presents a difficult combination for the central bank. Okay, so there you have it, our views on key developments, major market themes, and what to look out for next week. This podcast has been written by Andrew Ticehurst and the Global Markets Research team, and edited and produced, as always, by John Dalton, who is both talented and patient. Thanks, John, and thanks for listening in, all. If you did enjoy this podcast or would like to hear more, please like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud, or wherever you get your podcasts. And if you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log on to nomurakonnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision, and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice, nor is legal, regulatory, accounting, or tax advice, and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Numura Connects at www.numuraconnects.com.